Hey everyone, welcome back to Financial Fix Blueprint. Ready to finally take that step to move your money from passive saving to active growth? This video is for you. Today, we're demystifying the two most powerful and easiest ways for a beginner to get started: exchange-traded funds and mutual funds. Forget stock picking. These funds are your keys to instant diversification and long-term success. Before we dive in, it is crucial to understand this. The information presented here is for educational purposes only and is not personalized financial or investment advice. Investing involves risk. Past performance does not guarantee future results. The problem of single stocks. Imagine you have $100 to start investing. If you buy a single stock, say company X, and that company suddenly goes bankrupt, you lose everything. That's too much risk. The solution is diversification. Don't put all your eggs in one basket. Funds allow you to instantly own tiny pieces of hundreds or even thousands of different companies and bonds for one low price. They package diversification for you, which is the cornerstone of safe, long-term investing. Let's look at mutual funds. A mutual fund pools money from many investors to purchase a basket of stocks, bonds, and other assets. They are managed by a professional fund manager. They are priced only once a day, after the market closes. Because of the professional oversight and potential active trading, mutual funds often have higher fees, called an expense ratio, sometimes 1.0% or more. Next, we have exchange-traded funds. Similar to mutual funds, they hold a basket of assets, but they are structured like a single stock. They trade all day long on the stock exchange, just like a stock. You can buy one share or partial shares throughout the day. The way they are structured means they rarely pass on large taxable capital gains distributions to you at year-end, helping you keep more of your money invested and growing. However, there are taxation differences between countries. Check your own regulations. For most beginners, ETFs are the preferred choice due to their low fees and simplicity. Emotional discipline is key. Remember the human factor. Set up automatic contributions, and don't check your balance every day. Consistency and patience are the pillars of wealth. Checking your portfolio daily only leads to panic selling and ruins the magic of compounding. You now have the knowledge to move past the biggest beginner hurdle. The goal isn't to pick the perfect stock. The goal is to start as soon as possible. Your immediate next step is to open a low-cost brokerage account or check your 401 options. Pick a few diversified low-cost ETFs and automate your contributions. If you're ready to put this into action, hit the like button and subscribe. In our next video, we'll dive deeper into fixed income, explaining exactly how to use bonds and CDs to add stability and security to your portfolio. Thank you for watching. This content is not personalized investment advice. All investments carry risk, and you may lose money. Past returns or performance mentioned in this video are not indicators or guarantees of future results. Thank you for watching.